Most traders think the hardest part of trading is finding a good strategy. They spend months watching videos, reading books, buying courses, and testing indicators. But here is the truth nobody talks about. The hardest part is not finding the strategy. The hardest part is surviving long enough to actually get good at using one. And today, you are going to see exactly what that journey looks like. From the moment you place your first trade with zero knowledge, all the way to the point where you are managing funded capital and treating this like a real business. Every single rank in trading comes with a different version of you, different mistakes, different emotions, different beliefs about what the market is doing to you. And most people get stuck at one rank forever because nobody ever told them what actually changes at each level. So if you have ever felt like you were going in circles, losing the same way over and over again, or you passed a challenge but still feel like something is off, this video will explain exactly why that is happening and what you need to do at each stage to actually move forward. I want to be straightforward with you. This channel is built on one thing: real trading experience and real psychology, not theory dressed up to sound smart. The patterns you are going to see in this video are the same patterns that repeat across thousands of traders, regardless of what market they trade, what time frame they use, or what country they live in. The psychology does not change. The mistakes follow the same sequence almost every single time. And once you understand the full picture from noob to funded, you stop making decisions based on emotions and start making them based on where you actually are in the process. There is something called trader development stages, and it is not a motivational concept. It is an observable, measurable progression that every serious trader goes through. Each stage has specific characteristics, specific emotional patterns, specific technical blind spots, and specific turning points that either push you forward or keep you stuck. Think of it like a video game with different levels, except in this game, the difficulty does not go up based on time. It goes up based on your own psychology, your own patience, and your own ability to handle uncertainty without making stupid decisions. The first rank is the noob. You just discovered trading. Maybe a friend told you about it. Maybe you saw someone on social media talking about making thousands in a day. Maybe you just wanted a way out of your 9-to-5, and trading looked like the fastest answer. At this stage, you do not know what you do not know. And that is actually the most dangerous mental state in any skill-based field. You have enough confidence to open positions, but not enough knowledge to understand why those positions are wrong before they blow up in your face. The noob trader does a few things consistently. They trade every setup they see because they think more trades equals more money. They do not have a defined risk per trade, so one bad day can wipe out a week of gains. They move their stop loss when price gets close to it because they cannot accept being wrong. And they exit winning trades too early because they are scared the profit will disappear before they lock it in. These four behaviors alone account for the majority of blown accounts at the beginner stage. Not bad strategies, not bad market conditions, just these four psychological traps running on repeat. The most painful part of being a noob is that the market will occasionally reward these bad behaviors. You move your stop loss and price comes back. You overtrade and hit 3 winners in a row. You exit early and the trade would have reversed anyway. These random rewards are what keep you stuck. Your brain starts to believe that the behavior is correct because sometimes it works. And in trading, sometimes working is not good enough. You need a behavior that works consistently, predictably, and at a positive expectancy over hundreds of trades. The market teaches noobs through their wallets because that is the only classroom they are willing to sit in. At this stage, the thing that needs to change is not your strategy. It is your relationship with being wrong. Every losing trade at the noob level feels personal. It feels like the market is doing something to you on purpose. You start to think in terms of cheated, stopped out again, got hunted. And while liquidity mechanics are real and institutions do move price in ways that sweep retail stops, the actual issue at the noob level is not that you are being hunted. It is that you do not know where to put your stop in the first place. Fix that first, and the hunting narrative disappears on its own. The second rank is the struggling intermediate. This is where most traders live for the longest time. You are no longer completely lost. You know what support and resistance is. You have heard of order blocks, supply and demand, maybe Wyckoff or ICT concepts. You know that risk management matters, and you try to apply it most of the time. But your results are still inconsistent. Some months are green. Some months erase everything you gained the month before, and you cannot figure out why, because on paper, your setups look correct. The struggling intermediate is dangerous because you have just enough knowledge to feel confident, but not enough screen time to execute cleanly under pressure. You know what a breaker block is, but you enter before you get confirmation. You know higher time frames matter, but you still take trades that conflict with the daily bias because the 5-minute setup looked too good to pass up. You know not to overtrade, but at 2 a.m., when you have had a few losing sessions and you spot a clean-looking setup, you convince yourself this one is different. It never is. The emotional signature of this rank is frustration mixed with hope. You are frustrated because you feel like you should be further along by now. You have put in the hours. You have studied the concepts. You have journaled some of your trades, but the account still bleeds in ways that make no sense to you in the moment. The hope comes from occasional strong weeks that remind you this is possible. That gap between the frustration and the hope is exactly what keeps you in the game, but also exactly what prevents you from making the changes you actually need to make. Here is what has to change at this rank. You need to stop adding new concepts and start mastering fewer ones. The struggling intermediate almost always has what is called concept overload. They know 6 different ways to identify a trade entry, but they do not have full confidence in any of them. So they switch between frameworks depending on the outcome of the last trade. If the order block entry failed, they go back to just using support and resistance. If that fails, they add Fibonacci. This is strategy hopping disguised as learning, and it destroys consistency faster than almost anything else. The third rank is the consistent loser becoming consistent. This sounds like a contradiction, but it is not. There is a version of you that has lost consistently for long enough that you have finally accepted something most traders never accept. The market does not care what you think. Your opinion about where price is going is worthless until the market confirms it. Traders who reach this turning point stop arguing with price. They stop holding losing trades, hoping for recovery. They stop averaging into bad positions. And they start taking their stop losses without hesitation because they have finally understood that protecting capital is the actual skill. This is the rank where journaling stops being optional, because once you accept that you are wrong often, you want to understand exactly how you are wrong. You start tracking not just entries and exits, but the reason behind every trade, the emotional state going in, the time frame confluence, whether you waited for your setup or forced it. And over time, patterns emerge that are specific to you, not to trading in general, not to some generic mistake list. Your patterns, your tendencies, your specific version of impatience or overconfidence or fear of missing out. This self-knowledge is what separates traders who eventually get funded from traders who stay stuck forever. The psychology at this rank is quieter than before. Less reactivity, less revenge trading, less checking your P&L every 5 minutes while a trade is open. You start to care more about process than outcome because you have lost enough to understand that good process eventually produces good outcome. But good outcome without good process is just luck, and luck runs out. This mindset shift does not happen from reading about it. It happens from experiencing enough losses that your ego finally gets out of the way and lets you actually learn. The fourth rank is the prop firm challenger. You have decided to stop gambling with your own money and start proving your skills under real rules. The prop firm challenge is one of the most psychologically revealing experiences a trader can go through, and most people underestimate it completely. They think passing a challenge is just about being profitable for 30 days. What they do not realize is that the rules of a challenge create a completely artificial pressure that triggers every unresolved psychological issue you have been carrying since you started trading. The daily loss limit is the biggest one. Knowing that one bad day can end your entire challenge changes the way you trade in ways you do not expect. You start taking smaller positions than your plan calls for because you are scared of hitting the limit. You avoid setups that your strategy says are valid because you are still emotionally raw from yesterday. You hesitate on entries that used to be automatic because now the stakes feel higher. All of this is normal, but all of it also means you are not trading your strategy anymore. You are trading your fear of failing the challenge. The maximum drawdown rule teaches you something specific that no strategy guide will ever teach you. It teaches you what your actual risk tolerance is versus what you think it is. Most traders say they are comfortable with a 2% stop loss per trade until they are sitting inside a challenge and they have already lost 1.5% for the day, and there is a setup forming and they can feel the daily limit getting close. What they do in that moment, whether they take the trade, skip it, or size down, tells them more about themselves than 6 months of demo trading ever could. The traders who pass challenges the first or second time are not necessarily the most skilled technically. They are the ones who have already worked through their psychological issues before they started the challenge. They have a system. They follow the system. They do not improvise. They do not add new tools mid-challenge. They treat every day like it could be their last trading day, and they protect that opportunity like it is the only one they are going to get. Because actually, for For many of them, it was. The fifth rank is the funded trader. You passed. The certificate is in your email, the account is live, and now something strange happens that nobody warned you about. You are afraid to trade, not because you do not know what to do, but because the money is real now, and the consequences feel heavier. The prop firm can see every trade you make. The rules are still in place. And if you blow this account, you either have to pay again, or you have to accept that you failed something you worked months to earn. That psychological weight changes everything. The funded trader who struggles immediately after passing almost always falls into one of two patterns. The first pattern is ultra-conservative paralysis. They are so scared of losing the account that they barely trade, take only the highest conviction setups, and end up with weeks of flat performance that eventually push them to take a low-quality trade just to feel like they are doing something. The second pattern is overconfidence from the win. Passing the challenge gave them a dopamine rush, and they feel invincible. So they size up slightly, take a few extra trades, and within 2 weeks they are close to breaching the maximum drawdown on a funded account. Both patterns come from the same root: emotional trading instead of systematic trading. What actually changes between the challenge phase and the funded phase should be nothing. Your rules should be identical. Your position sizing should be identical. Your entry criteria should be identical. The only thing that should change is the account number in your trading platform. If you traded your challenge well and you follow the exact same process on the funded account, the results will follow. The problem is that the psychological meaning attached to the funded account is completely different from the challenge account, and that meaning is what breaks the process. The highest functioning funded traders treat the payout like an event that happens in the background of a consistent process. They do not trade toward the payout. They trade toward their daily and weekly process metrics. Did I follow my entry criteria? Did I respect the daily loss limit as a hard rule and not just a guideline? Did I exit my winners at my target without moving the goalpost because I thought price was going to run further? These process questions are what the payout eventually answers yes to. Chase the process and the payout shows up. Chase the payout and the process falls apart, and the drawdown breach shows up instead. Now let us talk about what actually changes at a practical level as you move from one rank to the next, because this is where the real money is. At the noob level, the only thing that matters is stop following your feelings and start following a rule. Any rule. A clear rule about where you enter, where you stop out, and how much you risk. It does not even need to be a great rule yet. It just needs to be a rule you follow consistently, so you can observe what happens when you actually stick to something. At this stage, consistency of behavior matters more than quality of strategy. At the struggling intermediate level, the practical change is time frame hierarchy. You need to build a habit of checking the higher time frame first, before you look at a single entry on the lower time frame. Most struggling intermediates work bottom up. They find a setup on the 15-minute and then look at the 1 hour to try to confirm it. But the correct direction is top down. The daily tells you the bias. The 4 hour tells you the structure. The 1 hour tells you the area. And the 15-minute tells you the entry trigger. When these four align, you have a high probability trade. When only two of them align but the setup looks clean, you have a gambling trade dressed up as analysis. At the consistent loser becoming consistent rank, the practical change is your journal, not a trade log, a real journal. Every trade needs a before note and an after note. Before you enter, write why. What is the higher time frame saying? What is the setup? What is your invalidation level? After it closes, write what happened and whether you followed your plan. Over 30 to 60 trades, this journal will reveal your actual trading behavior, which is usually very different from what you think your trading behavior is. Most traders are shocked when they read their journals back and see how many of their trades had no real reason behind them at the time of entry. At the prop firm challenge rank, the practical change is session selectivity. You cannot trade every session inside a challenge and expect consistent performance. You need to pick the sessions where your strategy has historically performed best and only trade those windows. If your strategy works best during the London Open, do not trade the New York close just because there is a setup there. The rules of a challenge punish bad days extremely hard because one bad day can take away 4 good days worth of progress when you are close to the maximum drawdown limit. Session selectivity directly reduces the frequency of bad days because you are only exposing yourself to market conditions your strategy is built for. At the funded trader rank, the practical change is payout planning combined with drawdown buffers. Most funded traders do not think about this, and it costs them. You should know exactly how much drawdown buffer you have at all times and trade proportionally to that buffer. If your maximum drawdown is 10% and you are already down 6%, you do not not trade the same size as you did when the account was at peak equity. You reduce size. You protect the account. You wait for a clean setup that fits your highest conviction criteria. And only then do you trade. This is not fear-based trading. This is capital management, which is one of the most underrated skills in prop firm trading. Here is the bottom line. Your trading life is not a straight line from confusion to profits. It is a series of psychological upgrades disguised as trading problems. Every time you feel stuck, it is because a specific version of you needs to change before the results can change. The market is not your enemy. Your unexamined habits are. The traders who make it to funded status and stay funded are not special. They are not naturally disciplined. They are not emotionless robots. They are people who went through the same confusion, the same blown accounts, the same frustration you are feeling right now, and they made a decision to treat each loss as data instead of as a defeat. That single decision changes everything. If you got value from this video, drop a like because it tells the algorithm this content is worth showing to other traders who are stuck in the same place you were before you watched this. Subscribe if you want to see the full breakdown of why most funded traders blow their accounts within the first 60 days of getting access, because that video will change how you approach every single session once you understand what is actually happening psychologically the moment a real payout is on the line. The next video is already uploaded, and it will answer the one question every funded trader is too afraid to ask out loud.